Welcome back to Fast Money. Stocks under pressure for the third straight day. The Dow, S&P, and NASDAQ all closing lower despite a late day rally into the close. We heard from the Fed a few hours ago. They released minutes from their last meeting, some members signaling a willingness to start talking about scaling back the Fed's massive bond buying program, quote unquote, at some point. In effect, that would mean tapering. Karen, how do you interpret this all and the impact on the markets?
I think it was sort of overblown. I mean, it would seem ridiculous to me that if the economy continued to heat up and GDP grew so quickly that no one would even consider talking about it. So the idea that some members would consider talking about it, about some date in the future to do it, okay, that shouldn't be news. It would be ridiculous to me if they didn't. So I think the market kind of freaked out for a minute and then, I don't know, hopefully realized that it was nonsensical to me, but right. Who knows?
Steve Grasso, your take.
I'm looking at the chart of the 10-year yield, and I know that we keep circling back to this, but we entered, in my mind, the reason why we haven't seen inflation other than in lumber and commodity prices, and I know that's more than enough sign of inflation, but the 10-year yield still can't take out that 1.74 level. And to me, that's ludicrous. So that means we entered into this environment in a deflationary world, and that's the bigger fright or scare, if you will. So I think the Fed knows this. The market is getting to know this. And unfortunately, there is no sign of inflation on the way that the Fed measures it. So I think that's the more frightening angle to this whole dynamic for the marketplace.
I mean, if the 10-year yield cannot take out 1.74, which is with the high back in March, even on the back of some very hot inflation numbers last week, James, I would think that that's actually very good news for the markets, knowing that we're sort of range bound and we're not going to take out that high. Doesn't look like it, at least.
Right. And the 10-year Treasury became a story, right? We were looking for reasons to understand, looking for things to understand, what was going to tip sentiment in this market. And the concept that the Fed came out, I believe it was in October of last year, and said, we're not doing anything for the next 36 months. I mean, there's nothing on record like that before, not in the Great Depression, not in 73, 87, 88. There's never been a statement like that before, and I think the market took it and ran with it. So now we're hypersensitive to anything the Fed says that would indicate a normalization of monetary policy in the 10-year Treasury. I believe it's one indicator, but we've got to look at these stock prices. We're just 7 trading sessions away from an all-time high on the S&P 500. Tech came down, but tech ran up so much stronger. I think that we're looking for ways to understand how monetary policy is going to go back forward. The Fed wants us all to be safe. We're going back to normal. Some of the mask restrictions are coming off. We're going to see what happens in this economy, and I believe there's going to be more commentary from the Fed about going back to normal for monetary policy, whether it be from an inflation standpoint, watching unemployment, or simply looking at the tone of how we're going back to normal.
So the bottom line sounds like buckle your seatbelts. Let's get to the Chartmaster meantime for some key levels to watch going forward. Cornerstone Macro's Carter Worth joins us now. Carter, what are you looking at?
Well, so we have a little bit of a dip, a decline, a correction, a pullback, a drawdown. Forget what you call it. The nomenclature doesn't matter. Let's try to put it in the context of the charts. So I have 4. Here's the first chart, and this starts just before the pandemic hit. We know we have that epic plunge, and then this recovery over the past 12, 15 months. And it's right on the trend line, in effect, since the pandemic low, and you can see it there in that chart. Now look at the second chart, exact same time frame, but what we're looking at here is all of the dips, corrections, pullbacks since the March low. Now there have been 6 in total. This is the 7th. And if you look at those 6, some are 8, some are 9%, some are 5, but if you look at all of those that are 5% or more, their average decline is 7.8%. Third of 4 charts. This is chart 1 and 2 together. So we have a sell-off right now, down 4.2%. Not as much as the average of 7.8, but it's right to the trend line. So do we hold or do we break? We're thinking we break. Now, where might we go? Final S&P chart. This is the same chart again, exact same time frame, but it has the smoothing mechanism, the 150-day moving average. And so, were we to go down to the 150-day, which essentially is rising quickly, right? It's around 38.25 now, but moving quickly. That's the nature of a moving average. We would come down to around 38.50. And interestingly, that would be exactly an 8% decline, which would put it along the average of all the other declines since the pandemic low.
38.50, but holding the uptrend, correct, Carter?
Well, we've broken the trend line. I mean, we're on the cusp of breaking it, right?
Okay.
We touched it there today at the low. I think we do break it, but we get to the 150-day.
Okay. I want to ask you about the story of the day, and that would be, of course, Bitcoin. Carter, you told us just days ago that the drawdown is garden variety. Are we still in the garden variety spectrum at this point?
Well, that's the nature of beta, right? Of course, is that drawdowns are different depending on the security or instrument in question. And this is wild stuff. What we do know is here too, in this instrument, Bitcoin, and you can look at the chart that's only a one-year chart, but before we examine it, we know that this has had a dozen or so sell-offs of greater than 30% since 2011. And the average sell-off is 56%. Some have been 90. All the others are 30 to 40. And guess what? We dropped exactly 55% here. So the question is this, though, what from here? It's always that, right? We've got to make our money each day, make our bets. And the issue now, as I see it, and you can see that on the chart on the screen, is that once you have a drop such as today, where you 30%, yes, you leave people trapped above. That's just the nature of what supply is, right? It's one thing to be down 4% or 2 or 12. Once you're down 30 from your cost base, it happens quickly. You become an interested seller. Get me out. Let me have my money back. And so while we bounce nicely off of today's low of 30,000 and change up to 39, any progress up towards 40 will induce, in principle, those who committed capital for the last 3 months, from mid-March to mid-May, will induce them to take their money out. So it's a very difficult moment to go higher. Overhead supply looms.
All right. Carter, thank you. Carter Worth of Cornerstone Macro. Nadine, I'm not sure what else you did today, but what really stood out was you buying copper.
Right. One of the things we think of is, and I've given it for some of our final trades, is just reflationary trades, whether it's energy, materials around the world. And so for us, we saw, amongst other things, copper trading off earlier in the morning. And so we got to pick up some good buys this morning when everyone seemed to be puking for, and also it seemed like, I think there was a hedge fund breaking down. So some of the color that we had gotten led us to believe that with that and implied volatility premium, so people paying for protection super high across the board and in our favorite reflationary places, energy, materials, financials, and so including copper, it was a time to actually enter the market, not get scared and get out, as Carter is saying that some people do.
Yeah. Karen, your take on the market action today?
Well, it was interesting to me. It sort of was led by Bitcoin, it seemed, right, when the market opened. And then I don't know if it was once Bitcoin sort of stabilized. There were sort of a couple things that, the MAGA complex sort of started to come back. And I'm not really sure why, but that was somewhat of a ballast for the rest of the market. So, I mean, names like Google and Facebook ended up the day up. There were some other ones that were, only down slightly. And then the semiconductor space turned around. So I don't know. I feel like the market just got kind of whipsawed, but net, not that much happened except Bitcoin.
Yep.
Shepard Smith here. Thanks for watching CNBC on YouTube.